Welcome to Investor's Guide. You're watching ET Now. This is the show that's been holding your hand for the last 5 years and looks forward to continuing to do so over the years to come. I must remind you that we're in the middle of November, which means we're inching closer and closer to the tax quarter. So if you haven't started making your tax investments, you should make them now and don't wait until February or March to make a last-minute investment. It's always wiser to start right now. And if you have questions about making tax investments, you can write to us. Email ID is at the bottom of your screen. On the show this week, we'll help a 36-year-old save for his retirement and for his child. In our product review, we look at the Kanhaiya Robeco Equity Diversified Fund, and we'll tell you which term cover will cover you even when you're traveling overseas. Let me bring in Kumar, the CEO of Value Research and our in-house mutual fund expert who joins us on this show every week. Dhirendra, thank you so much for joining us.
Thank you.
Let's get straight to our portfolio question. Well, Sumit writes in, Dhirendra, he's 36 years old. He tells us he has an income of 63,000 rupees. Interestingly, he has an emergency fund of 2.5 lakh rupees in his savings account, a term cover of 1 crore rupees and a health cover of 6 lakh rupees. So he seems to be covered on all of his contingencies. He has 5 lakh rupees in his PPF account. Now, his goals are obviously to look at his own retirement and to also to create a corpus for his child's education and marriage. All of these things are 15 to 20 years down the line. Now, other than the fact that he has insurance and he has contingency, he doesn't seem to have too much in terms of investments. He has 3 mutual funds, the Quantum Long Term, the ICICI Prudential Focus Blue Chip and the HDFC Balanced. Combined with his PPF account, they form his entire portfolio. Now, looking at his portfolio right now, would you say it's been put together with some sort of thought, or would you like to redo it entirely?
No, I think he has chosen excellent funds. And my only understanding from his overall picture is that he has way too much into his fixed income. That is on account of the PPF as well as the emergency fund, and it's quite an outsized one. So I would say that if you anticipate some real emergency for which there should be complete preparedness of this scale, then it's fine. Otherwise, you can make your emergency fund work a little harder. One is that first do a careful assessment that do you really need this scale of emergency fund, and some money should be in your locker, some money should be on your fixed deposit, and carry on with this plan. I think if you stick to this plan with one balanced fund, that too not a very significant, and 2 excellent equity fund through the lean times for your time frame, you should be okay. But I think the selection of funds needs to be reviewed periodically, maybe annually.
Well, Dhirendra, if he continues with these 3 funds, what would you advise him to do with his PPF account? Is that something he should continue as well?
I would say that he should just total up all his investments and all his accumulations so far, which is his emergency fund, his PPF, and also his employee provident fund. If his provident fund contribution, which he'll be making, there will be some worth of that. And I would say that given the kind of time frame he has and the kind of emergency fund he has been able to create, he should make sure that his fixed income allocation or his fixed income investment is not more than 20-25%.
We have another question from Pravin who writes in, Dhirendra, he's 49 years old. Now, for the last 4 years, he's been investing 2,000 rupees a month in the Reliance Vision Fund, Sundaram Financial Services Opportunities and Kotak 50. He says the funds have given him negative returns and he's not sure if he should continue this investment or withdraw his money. Now, these 3 funds together, Dhirendra, they're not the best combination. What would you like him to do now going forward?
It's very unfortunate that he has chosen just the undesirable fund, and also among the very unimpressive fund, very disappointing fund, and he has stuck to it. So I would say that he should just pull all his money out. He is unlikely to be faced with any long-term capital, any capital gains liability, because there won't be any meaningful capital gain. I would say that he should choose 2 balanced funds from our stable growth portfolio and carry on that plan. A sector fund in his portfolio where he's doing his SIP doesn't make sense. Likewise, Reliance Vision has been a consistent underperformer for a long time, and I'm not hopeful that in a short time span it'll start providing any meaningful return. He will be much better off with 1 or 2 balanced fund for 8-9 years, which he's planning to invest.
All right, Pravin, on your screen right now is our stable growth portfolio. Dhirendra is saying pick 2 out of the 4 funds that you can see on your screen, and these are all balanced funds. They'll give you a stable return. They also protect you from the volatility in the market to some degree. You can write that down and get back in touch with us if you have any more questions. 27-year-old Shirish has also written in. He invested in the HDFC Top 200, HDFC Prudence and HDFC Mid Cap Opportunities Fund. He can now increase his investment by another 5,000 rupees, and he wants to know how he should distribute that money. He also writes in, Dhirendra, saying that he has a 3-month-old nephew and he would like to invest some money on behalf of his nephew as well. How should he go about doing all of this? First of all, a combination of Top 200, Prudence and Mid Cap Opportunities, does that make sense? And then let's talk about his nephew.
One is that he will be, he's under the impression that he's investing in 3 different kind of funds, so he's getting a different exposure. No, he's getting the same fund management and he's getting different allocation. For example, HDFC Prudence is 70%, I would say, HDFC equity, and HDFC equity and HDFC top 200 is, there is a 65% overlap. So my sense is that if he's willing to withstand great volatility, he will be just well off by investing all his money into HDFC Mid Cap Opportunity. If he is very conservative, then he should be okay by investing all his money into HDFC Prudence. He should, work towards de-risking himself from consistent underperformance of HDFC equity funds, which they seem to be going through. I'm not saying that they will not do well over time, or they will do well over time, but just in case they continue to perform as badly as they have done in recent past, then he will be left in the lurch. So he should try and de-risk himself from that by spreading half of his money elsewhere.
If you could recommend one more fund for him, which is what he wants to diversify outside of this fund house, which one would you recommend for someone with a long-term horizon?
Assuming that he is going to be with balanced fund, then I would say that besides HDFC Prudence, he can well choose Reliance Balanced or ICICI Prudential Volatility Advantage Fund. They are also balanced fund, and he can combine these two. If he's looking for a mid cap fund, then not a pure mid cap fund, but something which will supplement this HDFC mid cap opportunity will be IDFC Premier Equity.
So there are 3 funds on your screen right now that Dhirendra suggests, 2 of which are balanced funds. So if you want to replace HDFC Prudence, then use one of the 2. And if you want to replace HDFC Mid Cap Opportunities, then you can use the IDFC Premier Equity. And of course, the same thing also holds good for your nephew as well, considering your time horizon is largely similar. Welcome back to watching Investors Guide in ET Now. Thank you so much for staying with us. It's time for our product review, and this week we're looking at the Canara Robeco Equity Diversified Fund. Avan is here to give us a quick introduction. Avan.
Thanks for that, Faye. Well, our fund under the spotlight today is the Canara Robeco Equity Diversified Fund. The fund manager follows a bottom-up investment approach with the focus on fundamentally strong companies with good scope for growth over time. Launched in September 2003, this fund was a foot dragger until 2006. Initially, the fund resembled a mid-cap offering with allocation to large caps below 50%. Only in 2007 did it move above 60% and has remained at that mark. In 2007, the fund delivered higher than the category average but fell close to 6% lower in the fall of 2008. Even during this period, the fund manager did not drop its equity allocation. And in 2009, it went on to deliver a shocking return of 93% to its investors. The fund bets on sectors like financials, technology and FMCG. So let's do some calculations to give you a better point of view. If you invested 1,000 rupees in this fund when it launched, you would have 6,329 rupees today. So should this fund be a part of your portfolio? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for that information. The Canara Robeco Equity Diversified Fund has not had a very impressive short-term track record. But if we still look at it over the last 5 to 10 years, it's still managed to beat its category average. Would you say the fund will at some point turn around and start to give us good returns again, or is it time to give up hope?
No, I don't think it is. There is need for any hopelessness here. But yes, this fund has been disappointing. Its tilt towards large cap has moved to a point where I would say that this fund has turned conservative. because in good times it was able to derive a good part of its return by diversifying across capitalization range, which I see getting marginalized of late. So, and I don't think the recent underperformance is that disappointing. Only in the last 1 year it has done 10 basis points less, generated 10 basis points less than its benchmark. So I don't think that is that's fair to say that it is a very disappointing fund. Yes, this fund is not as good as it used to be relative to other funds in the same category about a year back or 2 years back.
Well, Dhirendra, then what would you advise investors of this fund do right now? Should they just continue their SIPs and give it some more time?
If looking at very recent performance and last 11 months of underperformance and a stellar performance over the long period, I would say that investors should not change course here.
All right, don't change course here. Finally, Dhirendra, your rating of the Kanhaiya Robeco Equity Diversified Fund, where would you place it?
It certainly has slipped from where it used to be. I'll give it a 4-star, very much where it is on a risk-adjusted scale.
4 stars there for the Kanhaiya Robeco Equity Diversified Fund on Investors Guide. If you have questions about this fund for Dhirendra Kumar, feel free to write to us. Email ID is at the bottom of your screen. Let's move on now to our hold or sell segment. Ram writes in from Nairobi. He's investing in mutual funds for the last 3 years. He tells us he has a long-term horizon, Dhirendra, but he tells us the returns on his portfolio have not been impressive so far. He wants to know if he should make any changes. Of course, we must remind all viewers that a lot of equity portfolios are not showing returns at this point, but let's take a look at Ram's portfolio. His first 2 funds, Dhirendra, are specific to sectors, Reliance Banking and Reliance Pharma Fund. The Pharma Fund has not been a bad performer, but would you recommend someone with a long-term horizon have sector-specific funds like this one?
No, I would say that he should not have both the funds. Because even the reason why he should have diversified vehicles and funds which can invest across. Because today when I see any diversified equity fund, I find that they are significantly into banking. They might be, there might be marginal underweight or overweight to the weightage compared to index. But I don't see complete disappearance of any of these mainstream sectors. Likewise, pharma. So he just might feel happy that at one point, the pharma fund is doing well, but pharma will struggle when when there is a broad-based rally. So he should resist the temptation of doing.
Well, Dhirendra, I'm going to also call out the rest of the funds on his list. He has the DSP BlackRock Microcap Fund, which you talked about a little earlier, and the DSP BlackRock Balanced Fund. Now, with both of these funds, again, there doesn't seem to be a very clear thought in putting this portfolio together. Would you recommend he holds on to either one?
No, not at all. Once again, the microcap fund requires great mental strength, because here's a fund which struggles most of the time, and when it does well, it compensates for all the anxiety it has caused, and that is not for the faint heart. Likewise, the balanced fund, DSP BlackRock Balanced Fund, is a fairly average performing balanced fund for a while now.
Well, you did talk about having diversification in his portfolio, Dhirendra. He has Axis Triple Advantage Fund. Now, this is a fund that combines all 3 asset classes, debt, equity and gold. Is that something that's impressive to you? Would you recommend he holds on to this fund?
This fund has done well, but I don't see why it should find a place in a portfolio, because this fund was devised primarily to do well all the time, but not necessarily beat the benchmark or accumulate long-term wealth. With a long-term time frame, one should have equity funds, and one should have fixed income just to provide stability to the portfolio, and this is where this fund does not fit in, which combines everything in a single portfolio.
Well, he does have 2 impressive funds on his list. He has the HDFC Top 200 and the Tata Equity Opportunities Fund. Now, long-term track record, if we take into consideration, these funds are not bad and they're equity diversified funds. Should he continue with this investment?
Yes, this is the kind of fund which I was referring, which one should have, where you don't have to worry about it. And HDFC Top 200 has struggled in recent times. One can say that it has been a very average fund in over the last 3 years, and has been a significant underperformer or a disappointing performer over the last 8-9 months. But don't give up. Stick to your plan. This fund has too impressive a track record for a very long period of time to be given up on 8-9 months of underperformance.
And finally, Dhirendra, on his list is the SBI Gold Fund. Would you recommend he has a gold fund in his portfolio? I know you have fairly strong views about gold right now.
Earlier, I used to suggest people, investors, that if you want to accumulate small sums to be exchanged in lieu of gold, I have given up on that. If you need to buy gold over in a long time frame, accumulate your savings into equity and exchange it with gold. Exchange that accumulation with gold jewelry as and when you need it. You don't necessarily have to do it with a gold fund, which will have all kind of cost overlay. Also, the cost of managing a gold fund and the internal cost, primarily the customs duty which gets factored into the NAV. It will be better to accumulate something which is more tax efficient, which has superior credentials, and to be exchanged with gold, an asset class about which even if there is a reversion to mean, it is unlikely to be a great performer.
All right, Ram, that's the advice you're getting right now. You don't need gold in your portfolio, and Dhirendra asking you to hold on to two of those lists of funds, either the HDFC Top 200 and the Tata Equity Opportunities. Dhirendra, among all of our portfolios, for someone like Ram, what would you recommend he invest in if he were to give up on this portfolio and start afresh? Can he map to one of our portfolios?
Yes, one of the two portfolios, the aggressive growth or growth, with that understanding that the aggressive growth will be little more volatile than the growth portfolio.
All right, so on your screen right now is our growth portfolio. Of course, you can write back to us if you have any more questions. Dhirendra, thank you so much for spending time with us this week and answering all of our questions. Welcome back. You're watching Investors Guide on ET Now. Thank you so much for staying with us. Anil Sehgal joins us now to answer all of your questions on insurance. Anil, thank you so much for joining us. Welcome to Investors Guide. Well, 33-year-old Nikhil has written in. He has a term cover from LIC, but he says that's inadequate. He also wants to buy a cover right now that will cover him for about 12 times his annual income. Now, that's an impressive target to have. But unfortunately, Anil, he expects to travel overseas soon, and he wants a policy that will cover him even when he's traveling. And he knows a lot of the policies that are available online right now will not cover you when you're overseas. He also wants to know how important is it right now to go through a medical test when taking a large term cover, and will there be a problem during the time of the claim if he doesn't do the test right now? Anil.
Nikhil, firstly, there may be a miscommunication on the understanding that you have of the policy benefits. Typically, if you are resident in India when you apply for a policy, then the death benefit will continue to be paid irrespective of whether you change your residence. Now, as far as Aviva specifically is concerned, we have checked with the company, and the company has confirmed that as long as you were resident at the time when you took the policy, if you are traveling or if you change your residence later, the policy will continue and death benefit will be paid even if death is outside India. Having said which, you should have completed any travel related questionnaires and given all the information clearly to the company. The company only asks that you keep it updated on your residential details, and that is really from a policy servicing point of view, so that you continue to receive notices, etc. So there should be no problem as far as the policy is concerned if you change your residence to outside India. Now, as far as your question on non-medical versus medical policies is concerned, non-medical policies tend to be slightly more expensive. And also there is a declaration, these are based on a declaration of good health. So the onus is on you to have shared all the information correctly with the company when you are applying for the policy. The company will investigate if it feels that there is any reason for it to check that you have declared all the information truthfully at the time of claim. And will only question it in case they feel that there is any material non-disclosure or material misstatement. If you have completed all the details correctly and have not concealed any facts, there should typically not be a problem. Having said which, they are more expensive, and if you can, consider a policy which takes care of all the underwriting requirements at the time that you are applying.
Our next question comes in from Abhijit, who works in the government electrical utility department. He's getting married next year. Congratulations, Abhijit. He wants to know what health insurance policy he should buy right now, given the fact that he is going to be starting a family soon. Anil, what would you recommend?
Abhijit, it would make sense for you to, since you're getting married in January, to take a policy in January which covers you and your wife. So take a family floater plan. Also consider, since you're newly married, certain plans also provide for maternity cover, subject to a waiting period. So check what the waiting period might be, and consider plans which might also give you that benefit. Some plans have a longish waiting period. For example, Max and Apollo have 4 or 6 years respectively, and some of the others, for example Oriental, may have a lower waiting period. So keep that in mind and take a family floater plan.
Our last question comes in from Manoj, who writes in from Mumbai. He tells us he bought a whole life plan from Max and he's unhappy with the plan right now. He feels like he was missold the policy because he's already paid about 12 installments of the 5 lakh policy. He wants to know if it makes sense now, Anil, for him to move to another policy. What would you recommend he does?
Now, in a whole life policy, if the value of the policy exceeds the sum assured, then on death benefit changes so that the total policy value will be paid out on the death. So as far as the sum assured is concerned, the basic sum assured is 5 lakhs, and however subject to the policy value is higher, and that is what is paid out on death benefit. In the as far as your question on discontinuation and others is concerned, note that there is a penalty involved, and therefore you should ask the company for details and look at what that penalty might be before you decide to discontinue.
All right, that's a wrap on Investor's Guide this week. Thank you so much for watching the show. Remember, you can get in touch with us for any question you might have about your money. And of course, we're being specially partial to our women investors. Send in any question you might have. You'll find a copy of the show on our Facebook page, and you can reach me personally on Twitter. Thanks for watching.